Welcome to the long game. Today, we begin a journey into one of the underestimated forces in the world of wealth creation: patience. Not the kind of patience where you sit quietly in traffic or wait for your coffee, but a deeper kind. The kind that can build fortunes, that can turn a few dollars into a life-changing future, that can separate stress from peace in the long run. Let's begin with a familiar moment. You open your investing app. You take a quick glance, and there it is. Your portfolio is down again. The market's been red for 3 days straight. News headlines are loud. Social media's louder. Inflation, interest rates, layoffs, recession fears. Everything feels shaky, and in your mind, a quiet voice begins to rise. Maybe I should sell. It's in these moments, the quiet ones, the anxious ones, the lonely late-night phone glowing in the dark moments, that the true game of investing begins. Because investing isn't just a numbers game, it's a behavior game, and nothing challenges your behavior more than fear. Now pause with me for a second. Ask yourself, what's the emotion you most associate with investing? Excitement? Fear? Hope? Greed? Or maybe regret? Most people don't talk about it, but investing is an emotional sport. It touches your future, your family, your dreams. And when the market moves, it moves you too. But what if I told you that the greatest investors of all time didn't win because they were the smartest, but because they were the calmest? What if their edge wasn't knowledge, but patience? Let's look at someone you've definitely heard of: Warren Buffett. He's worth over $100 billion, and yet the secret to his success isn't hidden in some complex formula. It's not in Wall Street strategy. It's not even in picking the perfect stocks. It's in time. Buffett made most of his wealth after the age of 60. In fact, over 90% of his net worth was built after he turned 65. Why? Because he stayed invested for decades. He allowed compounding, that quiet, invisible magic, to do the heavy lifting. He once said, "Someone's sitting in the shade today because someone planted a tree a long time ago." That's not a metaphor. That's investing. It's planting seeds now and letting time grow them. But here's where most people struggle. They want the tree today. They want results fast. They want their portfolio to go up every week. They want to feel like their money is doing something impressive. And when it doesn't, they doubt, they panic, they jump ship. That's the trap. Because the market doesn't move in straight lines. It stumbles, it dances, it collapses and soars. And in the short term, it looks random, even cruel. But in the long term, the market has one quiet tendency: upward. If you zoom out on a 30-year chart of the S&P 500, you'll see something beautiful. Not perfection, not predictability, but progress. Despite wars, despite recessions, despite bubbles and crashes, the market rises. Slowly, steadily, patiently. So why don't more people benefit from this? Because they get off the ride too early. They panic during the dip. They sell at the bottom. They re-enter too late. They lose faith when the market wobbles, even though wobbling is its nature. Let's talk about that word again: patience. People misunderstand it. They think patience is about doing nothing. But patience is active. It's a choice. It's discipline dressed as stillness. It's the decision to say, "I don't need this to explode today. I trust the process. I'm here for the long game." Patience means understanding the difference between activity and productivity, between noise and signal, between headlines and history. A patient investor doesn't ignore the world. They just don't dance to its panic. They move with purpose. They research. They learn. They choose carefully. And then they hold. They hold when the market is boring. They hold when others are boasting. They hold when fear is loud. Because they know most wealth isn't built in the buying or selling. It's built in the waiting. Let me give you a simple, powerful example. Imagine two investors. Both start with $10,000. Both invest in the same index fund. But one stays invested for 30 years. The other pulls their money out every time the market dips 10% and waits 6 months to get back in. Guess who ends up with more money? The one who did just less. Because every time you miss the market's best days, you lose more than just opportunity, you lose compounding. And compounding doesn't forgive interruptions. It's like growing a plant. If you dig it up every week to check the roots, it dies. But if you water it, let it breathe, and give it light, it grows. So let's step back again. Let's ask a simple question. What are you really investing for? A car? A house? Retirement? Freedom? All of those goals take time. And if your goals take time, then your strategy must honor time. That's where patience isn't just smart, it's essential. You can't rush wealth the same way you can't rush trust, or healing, or growth. Because the best things in life, the real things, aren't quick. They are earned slowly, layer by layer, decision by decision. That's what investing is. Not a sprint, not a race, but a relationship with time. And like all good relationships, it needs faith. Faith in the future. Faith in your plan. Faith that even when things get rough, and they will, you stay grounded. Because here's what the impatient never realize. Every time you sell out of fear, you sell your future at a discount. But every time you stay through the storm, you buy a little more freedom. That's the game. And you win it, not by being the fastest, not by being the smartest, but by being the calmest. In the next part of our journey, we'll explore the math behind patience. We'll meet investors who stayed through recessions and came out stronger. And we'll explore one truth that almost no one wants to hear, but everyone needs. You don't need perfect timing. You just need time. Thanks for staying with me. Let's keep playing the long game.
Welcome back to The Long Game. In Part 1, we explored how patience isn't just about waiting, it's about how you wait and why you wait. Today, we go deeper. We shift from principle to proof. We ask, what does the data really say about long-term investing? And perhaps more importantly, how much does patience actually pay? Let's begin with a powerful visual. Imagine a chart of the S&P 500, the most commonly followed index of large U.S. companies. If you zoom in and look at the day-to-day price movements, it looks like chaos. Spikes, crashes, rebounds. Zoom out to a month, it's still jitters. A year, still noisy. But zoom out to 10 years, and you begin to see something different. Direction. Upward. Resilient. Consistent. Now go 20, 30, even 50 years back. Through wars, through bubbles, through inflation, deflation, recessions, and recoveries. And yet, the chart tells one story. If you stayed in, you grew. You didn't just grow, you compounded. Let me break this down with numbers. From 1926 to 2022, nearly a century, the average annual return of the S&P 500, adjusted for inflation, was about 7%. That means $1 invested in 1926 would have become over $10,000 by now, if left untouched. No trading, no market timing, just one thing: patience. Now contrast that with what most people do. According to Dalbar studies, the average equity fund investor significantly underperforms the actual market. Why? Because they buy high and sell low. They chase returns. They jump in when the market is hot and bail when it's cold. It's not the market hurting them. It's their own behavior. One of the most remarkable findings in behavioral finance is this: you can have the right investments and still lose if your emotions control your actions. Let's look at a case study. Meet investor A. She invests $500 every month into an index fund, no matter what. Rain or shine, up market, down market, she doesn't flinch. Now meet investor B. He tries to wait for the right time. When the market looks bad, he holds cash. When it looks good, he jumps in. But he always second guesses, always watches the news, always reacts. After 20 years, investor A, the one who simply stuck to her plan, almost always ends up ahead. Not because she predicted anything, but because she committed. That's the core truth. Consistency beats brilliance. Discipline beats timing. And patience beats perfection. Now, let's talk about market crashes, because this is where patience is tested the most. In 2008, the global financial crisis sent the market into a free fall. From its peak in 2007 to its low in 2009, the S&P 500 lost over 50% of its value. Panic was everywhere. Banks failed. Jobs vanished. Headlines screamed fear. It felt like the end. But those who held on, those who didn't sell at the bottom, they didn't just recover, they grew. From the bottom of 2009 to 2020, before the COVID crash, the market more than quadrupled. And even after the COVID crash, which caused another short-term 30% drop, the rebound was rapid. In fact, some of the best market days in history happened just days after the worst ones. If you sold during the fall, you missed the rise. That's why timing the market is so dangerous. It's not just that you might miss the upside, it's that the upside often comes when you least expect it. Let's say you missed just the 10 best days of the market over a 20-year period. That small absence alone could cut your returns in half. Miss the 20 best days? It gets worse. And the best days almost always follow the worst days. They don't come during calm. They come in chaos. So if you try to avoid the pain, you also miss the gain. Here's where patience becomes power. When you stay invested, you stop playing defense. You let the system work. The stock market is a machine, not of daily rewards, but of long-term value creation. It takes profits. It takes innovation. It takes human progress and packages it into growth. But you can only collect that growth if you stay in your seat. There's a quote I love from Nick Murray. Timing the market is a fool's game, but time in the market is your greatest natural advantage. Think about that. Your greatest edge isn't being first, or being lucky, or having insider knowledge. It's showing up and staying. Now let's be realistic. Patience doesn't mean blind faith. It doesn't mean holding a bad stock forever. It doesn't mean ignoring fundamentals. It means you build a plan based on sound reasoning, and you follow it. You don't let noise dictate your moves. You let principle lead, because the market will test you. It will tempt you. It will shake your confidence. That's what it does. But if your strategy is based on understanding and your mindset is grounded in patience, then each test becomes an opportunity to buy more, to double down, to lean into the long term when others retreat. And this is the behavior that builds wealth. Not once, but repeatedly. Let's talk one more time about compounding, because we often hear the word, but rarely feel its full power. Compounding isn't just a math trick, it's a mindset. It teaches you that the biggest returns come later. Not in year 1, not in year 3, but in year 20, 30, 40. It's exponential. It builds slowly, then suddenly. But to experience that growth, you must stay the course. You must protect your capital from its biggest threat, your own doubt. So, let me leave you with this. Patience in investing isn't just a virtue. It's a strategy. It's a superpower. And it's rare. Because the world rewards movement, but markets reward stillness. The world praises bold trades, but wealth comes quietly from the investor who shows up and holds on and lets time do what time does best. In part 3, we'll dive into the psychology of it all. We'll talk about how the brain fights against long-term thinking and how to train yourself to stay grounded when emotions rise. Because the market isn't your enemy, but your mind can be. See you in the next episode. And remember, fast may feel good, but patient wins.
Welcome back to the long game. So far, we've explored what patience looks like in investing, and why the numbers across decades of market history show us that time in the market beats timing the market every time. But if it's so clear, if it's so proven, why do so many people still struggle to stay invested? Why is it so hard to be patient? The answer, my friend, is not in your portfolio. It's in your brain. Let's talk psychology. You see, our brains were not built for modern investing. They evolved for survival, for danger, for the hunt, for immediate rewards. In a jungle or on the savannah, there were no index funds, no compounding returns, no quarterly earnings. There were threats and instincts and fast reactions. So when your portfolio drops 20%, your brain doesn't think, oh, this is just normal market volatility.
No. Your brain thinks danger, loss, run. It triggers your amygdala, the part of the brain wired for fear, for fight or flight. Your heartbeat speeds up. You feel discomfort, and you want to act, to do something, anything, to make the feeling go away. That's the trap. Because acting on emotion might make you feel better short term, but it can cost you everything long term. One of the greatest investors of all time, Charlie Munger, once said, "The big money is not in the buying or the selling, but in the waiting." And yet very few people wait, because waiting doesn't feel natural. It feels like inaction. It feels like you're falling behind, especially in a world that rewards motion. Let's be honest. We live in a world that celebrates fast trades, fast news, fast money. You open your phone, and in seconds, you can see 1,000 opinions, 100 charts, 50 headlines, and a dozen influencers screaming, "Buy now," or "Get out while you still can." It's no wonder we feel overwhelmed. No wonder we want to react. But long-term investing requires something very unnatural. It requires you to slow down while the world speeds up. It requires you to zoom out while everyone else is zooming in. That's not easy, but it is possible. Let me introduce you to a concept from behavioral psychology: loss aversion. This is the idea that losses hurt twice as much as gains feel good. In other words, losing $1,000 feels more painful than gaining $1,000 feels satisfying. That's why a 10% drop in your portfolio can feel like a catastrophe, even if you're still up 60% over the last 5 years. Your brain doesn't care about the long term. It reacts to now, to pain, to the red numbers. So how do we fight this? First, awareness. You have to recognize that your emotions are not signals. They are reactions. Just because you feel afraid doesn't mean you're in danger. Just because you feel uncertain doesn't mean you need to change your plan. You can observe emotion without obeying it. Second, build systems. The best investors don't rely on willpower. They rely on structure. They automate their investments. They dollar-cost average. They avoid checking their portfolios every day. Why? Because they know the more you look, the more you feel. And the more you feel, the more you risk reacting. A watched pot never boils, and a watched portfolio never calms. You don't need to see every tick. You don't need to read every headline. You need a plan, and you need to stick to it. Third, redefine success. This one's big. Most people think investing success means beating the market, or timing it just right, or picking the next big stock. But real success? It's staying invested. It's reaching your goals. It's sleeping well at night. It's being able to say, I'm on track for what matters to me, not what impresses someone else. It's not about the scoreboard. It's about the strategy. Let me tell you a short story. In 2004, Fidelity did a study on which of their clients had the best performing investment accounts. You know what they found? The top performers were people who had forgotten they even had accounts. Yes, The people who left their money alone. No trading, no tweaking, no reacting, just patience. Now maybe that story is part myth. It's been debated. But the lesson holds true. Sometimes the less you do, the better you perform. Because markets don't need your help. They need your trust. They need your time. And they need your ability to get out of your own way. So how do you develop that kind of mindset? Here are a few simple practices. Number 1, write down your plan. Be clear about what you're investing for, how long your time horizon is, what your risk tolerance is. When the market shakes, go back to that piece of paper. Let your past logic guide your present emotion. Number 2, limit your inputs. You don't need to consume market news every day. You don't need to follow 50 finance channels. Pick a few trusted sources and spend more time with your strategy than with speculation. Number 3, surround yourself with patience. That means listening to investors who value the long term, who talk about decades, not days, who aren't trying to make a quick buck, but build meaningful wealth. The people you listen to shape the way you see the world, so choose wisely. And number 4, celebrate staying. Every time you resist panic, every time you stay calm through volatility, that's a win. Mark it, acknowledge it, because those are the moments that build wealth. Not because they make you money in the moment, but because they protect your ability to keep compounding in the future. In the end, this isn't just about markets. It's about maturity. It's about growing into someone who doesn't need excitement to feel like they're making progress. Someone who finds peace not in motion, but in direction. And that direction? It's forward. Always forward. Slow, steady, sure. In Part 4, we'll explore how long-term thinking goes beyond your own portfolio, how it shapes companies, cultures, even countries. We'll look at why the greatest wealth isn't just personal, it's generational. Because patience doesn't just pay you, it pays those who come after. Until then, stay slow, stay thoughtful, and stay invested in the only thing that compounds more than money: your mindset.
Welcome back to The Long Game. In our last episode, we explored how our brains, wired for survival, not strategy, often work against us when it comes to long-term investing. But here's something we don't talk about enough. Patience doesn't just shape your results, it shapes your worldview. It changes how you see business, how you judge leadership, how you build legacy. Today, we're taking a wider lens. We're moving beyond the investor. We're looking at companies, at cultures, at how long-term thinking isn't just wise, it's transformative. Let's start with a question. What kind of businesses create real, lasting value? Not hype, not bubbles, not flavor-of-the-month trends, but businesses that endure. Businesses that last not just 5 years, but 50. The answer is simple. They're built patiently. Let's take Amazon. Today, it's one of the most valuable companies on the planet. But in its early years, it was a bookstore, a loss-making bookstore. For years, Amazon lost money. At Wall Street, hated it. Analysts said Jeff Bezos was reckless, that he didn't care about profits, that the company would never survive. But what Bezos understood, that most of the market didn't, was this: if you sacrifice today's optics, you can build tomorrow's empire. He reinvested aggressively into warehouses, into logistics, into cloud infrastructure, into people. And now, Amazon Web Services alone is worth more than most companies on the S&P 500. Bezos once wrote, "We are willing to be misunderstood for long periods of time." That's patience in action. Not passively waiting, but boldly executing without needing approval. The same applies to Apple. When Steve Jobs returned to Apple in the late 1990s, the company was weeks from collapse. He didn't chase quick wins. He focused on design, on quality, on experience. Years later, the iPod changed music. The iPhone changed communication. And Apple became the world's first $3 trillion company. Again, not overnight, but over decades. Because long-term thinking creates leverage. It allows you to make investments others won't, because you're playing a different game. You're not just thinking about the next quarter, you're thinking about the next quarter century. Now, let's shift to investing again. When you buy stocks, you're not just buying a ticker, you're buying a piece of a business, a team, a mission, a philosophy. And if you think like an owner, you care about how that business is run. You look at leadership, at capital allocation, at how they treat employees, at how they treat setbacks. Because real value doesn't come from hype, it comes from health. A healthy business doesn't try to please everyone, it tries to stay true. And as an investor, your job is to partner with those who do. The more patient you become, the more you start to notice things. You notice how some companies chase trends, while others build moats. You notice which founders think in decades, and which ones think in exit strategies. You notice that what looks cheap today may be expensive later, and what looks expensive today may be a bargain over time. Because price is what you pay, but value is what you get. And value takes time to unfold. Let's bring in one more angle. Legacy. You see, most people invest with a goal. A house, retirement, security. And that's good. But what if your investments could outlive you? What if your patience could become a gift? A gift to your children, to their children, to causes you care about, to futures you'll never see. That's the real magic of compounding. It's not just a math formula. It's a bridge between generations. Warren Buffett plans to give away the vast majority of his wealth, not by writing checks blindly, but by building a foundation of capital that will support meaningful work long after he's gone. That's long-term thinking at its highest level. It says, I may not be here forever, but what I build can be. So let me ask you this. What are you building? Not just in your bank account, but in your belief system, in your habits, in the way you think about time, risk, and reward. Because the more patient you become in investing, the more patient you become in life. You begin to understand that not every season is harvest, that some years are planting, that growth doesn't always show up right away. And that's okay, because the quiet work matters too. Let me share something personal. Many years ago, I started investing with just a small amount, not enough to retire on, barely enough to notice, but I kept going, month by month, year by year. There were moments of doubt, of fear, of temptation. Times when friends were flipping crypto or buying meme stocks and tripling their money in weeks. And yet, I stayed my course. Not because I'm smarter, but because I made a promise to myself. To grow slowly, to grow wisely, to grow patiently. And now, I look back and I see not just dollars. I see discipline. I see distance traveled. And most of all, I see peace. Because when you embrace patience, you stop fighting time. You work with it. You stop chasing, and you start building. And what you build patiently tends to last. In Part 5, our final chapter, we'll wrap it all together. We'll reflect on what it really means to win, not just financially, but personally. Because the power of patience isn't only about results, it's about who you become while you wait. See you in the next episode. And until then, stay slow, stay steady, and stay faithful to the long game. Welcome to the final chapter of our journey together. For the past 4 episodes, we've walked through the quiet power of patience in your money, in your mindset, in your habits, and in your future. We've explored data, we've explored psychology, we've explored legacy. But here, in our last part, we're going to explore something even deeper. What does it really mean to win? Because investing is never just about the dollars, it's about the life those dollars are building. It's about the kind of person you become in the process, and it's about how you define success. Let's start there. What does success look like to you? Is it retiring at 45? Is it being debt-free? Is it sending your kids to college? Is it having the freedom to wake up without an alarm clock? All of those are valid, but what ties them together is one thing: freedom. And here's the truth. Patience creates freedom. When you're patient with your investments, you begin to trust your system. And when you trust your system, you stop needing permission from the market. You stop reacting to headlines. You stop comparing. You stop chasing every new idea. Instead, you focus. You simplify. You breathe. You know where you're going, and you know how to get there. That clarity, that peace, that's wealth. Not just the number in your account, but the calm in your chest. And that kind of calm can't be bought. It's earned. Earned through years of showing up, of holding steady, of staying the course when it would have been easier to quit. That's winning. Not because you never lost, but because you didn't let the losses define you. Let me share one last metaphor. Think of investing like sailing. You don't control the wind. You don't control the waves. Storms will come. Skies will darken. But your job is not to panic. Your job is to adjust the sail, to stay on course, to keep moving forward, even slowly, toward your destination. And what gets you there? Not speed, not constant motion, but patience, day by day, knot by knot. Now let's talk about values, because what you believe about time affects everything. If you believe things should be fast, you'll grow frustrated. You'll give up too soon. You'll sabotage your own progress. But if you believe in seasons, in cycles, in building, in becoming, you'll start to see beauty in the waiting. You'll trust the slowness. You'll celebrate the quiet progress. You'll stop asking, "Why isn't it happening yet?" and start saying, It's happening. I just can't see it yet. And that shift, that internal shift, it changes everything. Because patience isn't just a money strategy, it's a life philosophy. When you master it in your portfolio, you begin to master it in your career, in your relationships, in your dreams. You stop rushing the journey. You start enjoying the process. You stop judging your pace. You start trusting your path. And that kind of mindset, that's rare. But it's available to anyone at any stage right now. You don't need to be perfect. You don't need to be rich. You don't need to have it all figured out. You just need to begin. To choose patience today. In a world that rushes, in a culture that demands fast, you get to say, no, I choose steady. Let others chase, you build. Let others sprint, you endure. Because the finish line isn't just about arriving, it's about how you arrive. It's about who you've become along the way. Now, if you've listened all the way through this series, take a moment. Seriously. Breathe. You've taken the time to think bigger, to zoom out, to listen to something quiet in a world full of noise. That's powerful. It means something is shifting in you, something subtle but lasting. Maybe it's the way you check your portfolio now. Maybe it's the way you respond to market dips. Maybe it's the way you've stopped chasing the next hot stock. Whatever it is, hold on to it. That quiet wisdom, that's yours, and no one can take it from you. So where do we go from here? Wherever you choose. But may I offer a small suggestion? Make patience a habit. Set your strategy, then protect it. Automate your investments. Tune out the daily noise. Check in on your goals quarterly, not constantly. Focus on what you can control. Your savings rate, your allocation, your behavior. Let the rest go. Because the market is not a scoreboard. It's not a casino to win every day. It's a field, a place where those who sow wisely and wait patiently eventually reap abundantly. You just have to stay long enough to let the harvest come. Before we end, let me leave you with this. Time rewards those who respect it. If you respect time, if you honor it, protect it, work with it, it will carry you farther than talent, farther than luck, farther than any short-term gain ever could. And that's the power of patience. It's not loud, it's not flashy, it's not immediate, but it's undefeated. Thank you for joining me on this journey. And as always, stay slow, stay steady, and never forget, in the long game, you don't need to win fast. You just need to not quit.